What if I told you that one evolving trade relationship could quietly shape India's economic trajectory for the next 10 to 15 years, and directly influence where smart investors allocate capital? Today let's talk about the India-US trade equation. Not from a political lens. Not from a diplomatic lens. But from a pure finance and investment perspective. The United States is already India's largest trading partner, with bilateral trade crossing well over $100 billion annually. Now both countries are pushing toward deeper trade integration, reducing tariffs, strengthening supply chains, increasing defense collaboration, expanding energy partnerships, and improving market access across multiple industries. Whenever two large economies deepen trade ties, three major financial shifts typically follow. Exports rise, foreign direct investment increases, and globally integrated companies generate stronger, more stable revenue streams. For India, stronger ties with the US also mean higher dollar inflows, better global positioning, and reduced overdependence on China in global supply chains. Let's break down what this means sector by sector. The most obvious beneficiary is the IT and technology sector. A large portion of Indian IT companies derive significant revenue from the US market. Deeper trade cooperation could mean smoother mobility rules, larger outsourcing contracts, stronger cloud adoption, AI collaboration, cybersecurity partnerships, and digital transformation mandates. From a finance perspective, dollar-denominated revenue acts as a natural hedge against rupee depreciation. However, there is a flip side. Heavy US dependence means earnings are sensitive to American economic slowdowns. So IT remains structurally strong but cyclical in nature. Next comes pharmaceuticals. The US is the largest market for Indian generics. Indian pharma companies already dominate a significant share of prescriptions in the US. If regulatory pathways become more streamlined and trade friction reduces, export volumes and approval cycles could improve. Pharma offers something powerful: export growth combined with defensive demand. Healthcare consumption does not collapse during recessions. But compliance risk is real. US FDA regulations are strict, and even one warning letter can impact stock prices significantly. So quality of management and compliance history matter deeply here. Now let's move to manufacturing and electronics, possibly the most structural theme of the next decade. With global companies pursuing the China Plus One strategy, India stands as a strong alternative manufacturing hub. If the US actively supports supply chain diversification toward India, we could see growth in electronics manufacturing services, semiconductor assembly, auto components, capital goods, and specialty chemicals. Combined with India's production-linked incentive schemes, this could trigger a multi-year capex cycle. For investors, this is not a one-year trade. This is a 10-year positioning opportunity, provided companies maintain healthy balance sheets and avoid excessive leverage. Defense is another strategic area. Stronger geopolitical alignment often translates into joint manufacturing, technology transfer, and larger procurement contracts. India is one of the largest defense spenders globally. Domestic defense manufacturers with strong order books and export capabilities could benefit significantly. But defense earnings are policy-driven and lumpy. They require patience and understanding of order execution cycles. Energy and clean technology is another evolving pillar. The US is a major LNG exporter, and collaboration in renewable energy, green hydrogen, battery storage, and electric vehicle ecosystems could accelerate India's energy transition. This opens long-term opportunities in renewable energy equipment manufacturers, transmission infrastructure players, and EV ecosystem companies. However, this theme requires long holding periods and careful evaluation of debt levels. Now let's talk about sectors that are often ignored in headline discussions but are extremely important: textiles and agriculture. India is one of the largest exporters of textiles and garments globally. If trade terms improve and sourcing shifts further away from China and Bangladesh, Indian textile exporters could gain meaningful market share in the US. However, textiles are labor-intensive, margin-sensitive, and cyclical. They depend heavily on US consumer demand and cotton prices. So while this sector benefits from trade expansion, it remains volatile. Investors should focus on integrated players with strong export visibility and efficient working capital management. Agriculture and food exports also stand to benefit. India exports rice, spices, marine products, processed foods, and ready-to-eat products to the US. Trade facilitation could mean smoother sanitary approvals and stable export contracts. Food demand is non-cyclical, which adds stability. But this space faces currency risk, commodity price volatility, weather dependence, and strict US regulatory standards. Branded and value-added food exporters tend to have stronger pricing power compared to pure commodity exporters. Beyond individual sectors, there are secondary beneficiaries that investors often overlook: logistics companies, port operators, container manufacturers, warehousing players, and even MSMEs integrated into export supply chains. When trade volume increases, logistics efficiency becomes critical. This can drive structural growth in transport and infrastructure-linked businesses. But now let's pause and talk about risks. Trade relationships are influenced by political cycles. A shift toward protectionism in the US could reintroduce tariffs. Currency volatility can impact export margins. Overdependence on the US market exposes Indian companies to American recession risk. Regulatory and compliance requirements, especially in pharma and food, remain stringent. And global trade tensions elsewhere can indirectly affect sentiment. So how should investors think? This is not about chasing headlines. It's about identifying structural tailwinds early. Companies with strong return on capital, manageable debt, export diversification, and consistent cash flows stand to benefit most. Sectors like IT and pharma offer higher margins and capital efficiency. Manufacturing and electronics offer structural growth. Textiles and food exports provide volume expansion but with higher cyclicality. Defense and clean energy offer long-term policy-backed themes. The intelligent approach is diversification across themes aligned with India's rising global role, not concentration based on hype. The India-US trade relationship is more than diplomacy. It is about capital flows, supply chain realignment, export competitiveness, and long-term economic positioning. The real wealth creators will not be those reacting to news alerts. They will be those who understand how macro shifts translate into earnings growth. So the real question is your portfolio positioned for India's global integration story, or are you still investing based on yesterday's domestic-only narrative? If you want more macro-driven investment clarity like this, subscribe to Mimo, your virtual finfluencer. Let's build wealth with understanding, not noise.